This is Chad Stayskull, founder and managing partner of Eagle Wealth Management. I'm here to share some insight on the upcoming election and hopefully help you maintain some feeling of confidence even in these times of chaos. The 2020 election is coming up fast, and we keep hearing the same question: how will the election affect the markets? In this video, I'm going to share some of the information that we've gathered so far and give you 3 things to keep in mind as we plan for some of the unknowns. Well, just a few months ago, the results of the election was not considered too much of a concern for the markets. Yes, we know. The election has significant stakes regarding policy, but we're talking about the stock market. The likelihood that the Senate or House would change leadership was considered low. And historically, a divided House leadership has been the best case scenario for the markets. With division comes difficulty of passing significant policy changes, which is usually good for the stock market as it usually likes the status quo. Now, City National Bank's investment leaders consider it somewhat likely, or a little more than 50% likelihood, the Democratic Party may sweep the November elections. Our friends at City National Rockdale have shared the following slides to help us visualize the current political environment. Now, I wish I could tell you there's a clear election cycle trend, and depending on those results, we should make some changes. But according to our data, in every presidential election since 1928, the S&P 500 has been positive on both a median and average basis, with the election year providing the second best average returns behind year 3. We can also see that since 1945, the political party that controls the executive and legislative branches have mostly all had success based on stock market returns. So what does this all really mean? This means that there's many more factors that drive the economy and stock market than just election results. So let's take a look at a few. As of July 2020, dissatisfaction is at historic highs. A Gallup poll showing that 86% of Americans are dissatisfied with the way things are going in the country. It's approaching the peak seen in the 2008 financial crisis, and it's also a very rapid change from February, just before the coronavirus forced widespread business shutdowns and increased unemployment in the United States. So what does this mean for the election? Well, just like in 2008, when we see this kind of dissatisfaction in an election year, there's a much higher likelihood of changes in government leadership currently in power. Recent polling for the presidential race is leaning slightly Democratic. We've heard this story for some time, and markets seem to have mostly accepted a change in the White House. Poll results are updated daily, showing Joe Biden with a lead, albeit narrowing nationally over the last month. The possibility of the House changing leadership is low, and it's likely Democrats are going to maintain control. But as mentioned at the beginning, the Senate is a different story. A few months ago, many thought a change in leadership within the Senate was very unlikely. But now, it seems there's a chance the Senate may flip to the Democratic Party as well. There are potentially 9 Senate seats up for grabs, and if the Democratic Party wins the presidential race and gains control of the Senate, they will have enough power to make larger policy changes. So what policy changes might a Democratic government make that could affect investors' portfolios and wealth planning? Let's take a look at Biden's numerous tax proposals. Many of you have heard about changes to personal taxes, so let's start there. While we don't like to hear about taxes going up, the proposed increases are mostly targeted at those making more than $400,000 a year. One major proposed change will lower the top tax bracket income level to $400,000 and increase the top tax bracket from 37% to 39.6%. That doesn't sound like that much, but this change is compounded for high-income workers as personal Social Security taxes of another 6.2% will be added to income over $400,000. We're also monitoring the proposed increase on long-term capital gains rates. While this could cause some concern in the markets, this change only impacts those earning more than $1 million a year. So we don't feel this proposal will be as significant as it could be as if they just removed the long-term capital gains tax rate. According to our data, since 1955, there appears to be no real correlation between an increase in capital gains top tax rate and the S&P 500's returns the next year. Considering this change will only impact less than 1/2 of 1% of people, we don't believe there's a reason to make portfolio adjustments. Although, on an individual holdings basis, it is a reason to look at holdings to see if there are ways to minimize capital gains based on current tax rules and these proposed changes. For those of you earning below $400,000 a year and living in states like Oregon and California that were negatively affected by the limited itemized deductions of state and property taxes, you shouldn't see much of a tax increase, if any at all. And it's possible you may even see lower total tax with the removal of the state and local tax, or SALT, deduction limit going back above the $10,000. We consider this a positive change for many people who saw their taxes actually go up in 2017 with the tax cuts due to these limited deductions. We anticipate the proposed changes to the estate tax to affect many taxpayers, but especially the top 1% of wealth. Lowering the estate tax, or death tax exemptions, by almost half will mean that much more of larger estates will be taxed. Again, this will not affect many people beyond the top 1% of net worth individuals, but the repeal of the step-up of basis at death will affect most, as many people own stocks and other assets that have gains that could be taxed when they pass away. So how many of the key Democratic proposals impact the economy? Or more directly, corporate profits and the stock market? Well, the increase in corporate tax rates will be the biggest negative impact on corporate profits. We do feel that if we see some forward progress on trade tariffs, which is just another type of tax, could possibly offset some of those increases in the corporate tax. The increase in personal taxes and capital gains for very high income earners won't be good for corporate profits, but are not going to be too significant for the stock market. On a positive side, corporate earnings could benefit from extra money spent on updates to the country's infrastructure. In summary, every one of these changes is going to affect someone in this significant way, but we don't think these changes are substantial enough to warrant massive changes to portfolios for long-term investing. But in the future, it will be much more important to consider which industries, sectors, and asset classes to invest in. 2020 has been wild, to say the least, and the upcoming election could be one of the most divisive races we've ever seen. Add in a pandemic, numerous national disasters, social unrest, confusing market trends, and it's no wonder people are confused. But let's try to trade panic for perspective. Here are 3 ways to help prepare for this election uncertainty. 1, it's normal for markets to be more volatile in election years. But remember, other factors are always at play. Business cycles, interest rates, corporate profits, and of course, unprecedented events like the pandemic. So what can you do? Take a deep breath. And let's try and focus on post-election period. 2, markets don't like volatility, and they don't like surprises. So we can expect things to be a bit bumpy in the short term, especially in the weeks before and after the vote. 3, regardless of who wins, government will be focusing on the coronavirus and the country's economic recovery. We don't know what it will look like or how quickly things will happen. The good news is, if you're an Eagle Wealth Management client, then we already have a plan to pursue long-term success, no matter who wins in November. I don't have a crystal ball, but I do have the advantage of knowing what has happened in the past and being able to prepare for what could happen in the future. While the past can't predict the future, we can look at it for perspective. If you have questions about how the election might affect your financial plan, or if you just want to talk, please feel free to give us a call, 541-330-0220. Once again, this is Chad Stayskull, signing off for our special update on the election and the markets.